My name is Ben Reppond. Welcome to my YouTube broadcast. Today is September 6, 2023. I'm going to give you the picture from last week that what was the most dominant thing in the financial news was the jobs report. And when it came out, it was mixed. And I thought this interview that Scott Wapner did with Roger Ferguson was a very balanced and correct view of it. We added 187,000 jobs, new jobs to the economy. They expected 170,000. So you'd say that's positive. It was. But they also revised the previous data down 100,000. And unemployment, even though that happened, the unemployment data shows the unemployment rate went up to 3.8%. So he's pointing out that data is kind of going in different directions. There's some that are positive, some that are negative. Consumer spending continues to be positive. So there's reasons that he believes that probably the Fed will not raise rates. They will probably continue to hold rates at their September meeting. But he's very cautious and says it's data dependent. We'll have to see what data comes in. So if it points one way or the other, it'll cause them to either, I doubt they're not going to drop rates, but whether they pause or increase rates will be based on the data that comes in between now and the September meeting.
For a closer look now at the jobs numbers and what it could mean for the Fed, let's turn to former Federal Reserve Vice Chairman Roger Ferguson. He's now a fellow at the Council on Foreign Relations, a CNBC contributor as well. It's nice to see you. So Jay Powell sees this morning and says what?
He says, look, first, we look at all of the data that have come in and try to draw a general picture out of that. And I think there are three separate forces that are going on here. First, over the last couple of days, we've seen that consumer spending still is very strong, which is net positive, but could feed to inflation. Secondly, we had some inflation numbers that I would say are a little mixed. So headline inflation staying pretty steady at that 0.2% month over month, good story. Looking down at what's called the core PCE services focus, that one was maybe just a little high. So, a little bit of a mixed story there. Today's job numbers showing what I think is a healthy economy, bringing new people into the labor force, leading to a somewhat higher unemployment rate. But overall, I'd say this looks like it's a mixed story, not one to be too panicked about, and perhaps supporting a pause in September, but not taking future rate hikes off the table just yet.
Okay, get into this is as of last Friday. This is the dashboard report. Last week was a very positive week for the equity markets, not so much for bonds. Bonds continue to be weak. But you can see with the 6 equity indexes I've got, the 4 U.S. indexes, S&P, NASDAQ, Dow, and Russell 2000, that those 4, plus the 2 foreign indexes, developed and underdeveloped markets, that nearly all green dots, meaning that they are above their 20, 50, 100, and 200-day moving averages. And so you can see in the first box, the yellow box, that's the last week's data, everything was positive, except, of course, for bonds. Bonds, long-term government bonds, continue to be down. They're not only down for the week, but they continue to be down for the year. No surprise. Then in the pink box, you can see how they've done. NASDAQ 100 has done extremely well, up 41% for the year. S&P up 17, Russell 2000 up 9, et cetera, all the way down to emerging markets, which were up 4.5%. And nearly all are above their moving averages. So a very positive report for equities, U.S. equities, and foreign equities. When you take the S&P 500, you see some of the data underneath the surface, and again, the yellow box shows last week, every single sector in the U.S. economy was positive, except for consumer staples. And it was negative by 0.39%. So a very good week. And then year to date, technology and consumer discretionary by far ahead. This goes all the way down, and then you get to the last, I'll say the last 6 sectors, up 3%, up 1, up 1, up 1, down 3. So that's year to date. So there are some that are doing really well, and there are some that are not doing well at all. So I'd say that's kind of where I draw the line. You could even draw the line after the first 2 and say, other than that, those 2 are holding up the market, maybe. Okay. This shows the same picture. This is a chart of the S&P 500, a weekly chart, and I drew the black arrow from October to present, and you can see general direction is positive, and then the last 2 or 3 weeks, I think it's the last 2 weeks, definitely positive at the end. This is the last 4 weeks. This is a kind of a micro chart showing just 4 weeks of data using candlestick methodology or pattern. And you can see the market went down. And actually, the first part of the chart is a couple of weeks, but there's actually a couple of weeks before that, or maybe a week before that, where it was also coming down. So it went down for about 3 weeks. And then this last week, I drew the arrow, this last week, very positive, and you can see where it is now. When I look at the growth stocks in the market versus the value, SPY G is growth, SPY V is value, SPY G is numerator, SPY V is denominator. So when the line on the chart goes up, this favors growth, the numerator. When it goes down, it favors value. So you can see, coming out of last year, you can see the degree to which it went down favoring value. Last year, generally speaking, was a value year. This year, beginning with the bottom of the black arrow, generally speaking, is positive. So it is definitely going up, and you can see in the last month where it has gone as well, pretty much all oriented to growth. Okay, next is the relative strength chart of S&P 500 versus small cap. S&P 500 SPY, numerator, small cap, IWM, denominator. As this goes up, that favors large cap. A down move favors small cap. And you can see, I mean, through last year and I guess February of this year, it went back and forth a lot, really not favoring one or the other as a particular pattern. And then all of a sudden, large cap took off. And you see where it is today. This is not a relative strength chart. This is an absolute chart showing the long-term government bond ETF TLT and where it has gone in the last 18 months. Last year, going through, I guess, October or so, generally speaking, the government bonds, all bonds, but government bonds in particular, and this in case of the ETF, just got clobbered. And at some point they were down, I think I remember seeing down 20%, 25%, horrible decline. And then tried to go back up and then has collapsed. So I drew an arrow from April to present, and you can see the general trend is down. Last week was down, year to date's down. And of course, this is putting a drag on 60-40 traditional portfolios. And, you know, portfolios are not always traditional methods are very diversified. They're not in what's in favor necessarily. They don't try to be, and then they blend them with bonds. So I think traditional portfolios are fairly anemic this year. And I haven't seen any, but I just know how they allocate, and this is definitely putting a drag on it. So The dollar in the short run has been going up and continues to go up relative to other currencies. It doesn't mean the dollar itself is strong, because we've got all kind of issues with debt in our country that should be putting a drag on this. I think it does, but relative to other currencies, since we're the reserve currency, the dollar is rising relative to other currencies. Gold had a good week. It went up again, and the general direction of gold in the last year is up. Silver went down just a little bit, or even that might even be neutral for the week. The data I got, I'll show you later, showed zero change, and so that's approximately zero. But same period of time, silver has gone up. Silver is more volatile. It goes up and down, goes up higher and comes down further, and you can see that on this chart. When I put a relative strength of silver, numerator, gold, denominator, going up would favor silver, down favor gold, you can see again it goes up and down a lot. BITO, Bitcoin ETF, we trade that in our managed crypto model, and it has been down. We've been out of it for quite a while. We've avoided virtually all of this decline, and but picked up some good gains during the first part of the year through the month of May, and that's our strategy is up 39% for the year, and we've not picked up all of the gains, and we've not avoided all of the losses, but we have participated in a lot of the gains, and we've avoided a lot of the losses. So again, I have no idea when it's going to start to go back up, but one day it will. There's a lot of thinking that maybe Bitcoin is, because of the methodology and the computing, is going to have a sharp increase in value because of the way they do their methodology. I won't get into it, but the way they do that, they think that sometime in April or May of next year, it is expected to go up substantially. I don't know. We'll see on that. Volatility, because it was a good week in the equity market, S&P and other equities, it was a good week, so stocks went up, volatility index went down. And you can see from October of last year to present, it's been in a decline mode. Asbury Research, the Asbury 6 has gone from a couple of weeks ago, all negative to all positive. So again, it flipped a lot of those indicators over to the positive camp. The cross-asset relative performance comparing one asset versus another, ETFs actually. So SPY versus AGG, which is the bond index, bond tracking benchmark, stocks in favor for the month, the week, the month, the quarter. High beta stocks more in favor than low volatility stocks. The broad market, the S&P 500, is stronger than the Dow. That's been true most of this year. And growth stocks more in favor over value stocks. We've seen that. And the U.S. Is stronger than the emerging markets and developed markets for the last week, the last month, the last quarter. Bonds, high yield bonds are more favorable than corporate bonds or high quality bonds. And short-term bonds are more favored than long-term bonds. The U.S. versus the world. I want to apologize for getting something incorrect here. I learned that this is what I've been saying is not correct, so I want to correct it. The fact that the U.S. is not in green does not mean it's not favored. So if it says U.S., the U.S. is favored over these other countries. And in some cases, you can see, like in Canada, Australia, Japan, Hong Kong, Thailand, etc., there are some cases where, short-term, where other countries are stronger than the U.S. So I thought I would show you. I just took one of them. I looked at several, and I thought this would give you the strongest indication of like the last week, the last month, the last quarter of how much stronger the U.S. is over the U.K. And again, I looked at other countries. I looked at some in Europe and Asia and so forth. This was a good representation of the strength of the U.S. Market, measured by SPY versus the ETF that we use for the UK, which is EWU. Okay, the gold and silver. Gold, as I showed you earlier, had a positive week. Silver, no change from the previous week. Gold is $19.43 spot price per ounce. Silver, $24.30. And this is as of last Friday. The gold-silver ratio is 80-1. When you look at buying silver as in a monster box, which is people can afford it, that's a good way to buy it. 500 ounces, this is bullion, this is not Silver Eagles or Canadian Maple Leafs or anything. This is generic and generic silver. The markup this last week is $2.29 per ounce. And when that's added to the spot price, which I just gave you, it for 500 is $26.59, and in a tube of 20 is $27.09. And the box is $13,295. And the source of my information is my son, Preston, who is in the precious metal business. I talked to him this week, and I got a call from a listener, and I referred her. She wanted to sell some silver bars, some 100-ounce silver bars. So I referred her to my son, Preston, and he talked with her, and they're, East Coast, West Coast. And so I said, can you help her? And he said, Dad, it would cost her about $80 per bar, 100-ounce bar. Cost her about $80 to ship that. And that would eat up too much of the gain. And I think it would be in her best interest to sell it locally. And I said, well, how do you recommend she do that? He says, what I tell people is go to 5 different retailers in your area. If you have that many, go to 5 of them and get prices from them when you're selling or buying generic, or whatever you're buying, silver or gold, whatever you're buying. Go to each one, make sure your specifications are the same, and take the one with the best price. I thought that was good advice, so I'll pass it on to you. Sometimes the market just goes up and up, and we think it's going to continue to go up. We know it's not going to the moon, but we think, we're in a bull market and it's going to keep going up. Well, sometimes it doesn't work that way. So as we think of the market and investing, we have to remember there are both components, both up days and down days. Thank you for watching. If you have a question or a comment, leave them in the comment section below. Thank you.